Hi, this is Ernie Diapera, your financial consultant online. In observance of Liam, or Life Insurance Awareness Month, I think it's high time to answer the question, do I need life insurance? Well, let's take the short quiz. Does anyone depend on you financially? Got loans? A mortgage? Do you care about your family? If the answer is yes, you probably need a life insurance. But the question is, which one? Before I answer that, let me show you the 5 pillars of how you save our money. A lot of you, let's say you're saving $200 a month and you're thinking, where do I put it? Perhaps majority would say, I want to put it in my savings account and, build my emergency funds. That's good. Some of you, if you have 401k, especially if it's being matched, then perhaps you want to overfund your 401k. That's great. If you have kids, probably you're thinking, I'm going to open college funds for my kids. That is awesome. Or if you own a house that has mortgage, you probably want to pay extra $200 on your mortgage. But the problem is, let's say 2 years later, you passed away. Now, what happens with your emergency funds? Well, you were able to save extra $4,800 2 years later. Of course, that's not enough to even give you a decent burial. But what about those who, overfunded your 401k with extra $200? Again, you've added 4,800 there. And of course, this fund is subject to 59.5 rule. That means you cannot even touch it unless you get penalized and taxed. That means you're losing 40% every time you touch it before you turn 60. What about college funds? We know that there's nothing for college for your kids. What about your mortgage? Wow, it didn't put a dent even on your mortgage because it's nothing. And very few of you would think, what if I use the same amount of money to buy me a $1 million term insurance, assuming that you are still insurable? Wow. And then you pass away 2 years later. How much are you leaving your family? That's a whopping $1 million in 2 years' time. You see, life insurance is the quickest way to have funds available for your family should anything happen to you unexpectedly, especially if your funds are limited. Now that you're convinced that you need a life insurance, which life insurance should you have? Well, the most common and the cheapest is term insurance, which I call the traditional, or should I say, death insurance. Because if you bought a 30-year term, which could be very cheap, especially if you bought it at a very young age, and you're only 30 years old, what are the chances that you were out to live it? Well, 98%. So what happens when you outlive it? You lose everything. But of course, it's still better than nothing because at least you're going to have peace of mind in the next 30 years. Recently, they added living benefits on your term insurance, which to me is awesome because now you can call it life insurance because you don't have to die to access your death benefit. Because if you, let's say, lost 2 of your 6 activities of daily living and it lasts for 90 days, now you can access your life insurance death benefit 2% monthly. What are the ADLs, or activities of daily living? Continence, that means you're still able to control your poo and pee. You don't need a diaper. But as you age or perhaps something happened, now you become incontinent. That's one. And transferring, the ability to be mobile. And then there's toileting, bathing, dressing, and eating. You do that every day as a normal person. And once 2 of these ADLs are not non-functional, that means you lost 2 of your 6 ADLs even temporarily. But as long as it lasted for 90 days, now you're able to access 2% of your death benefit monthly at any age. To me, that is an income replacement right there. So if you have a $500,000 death benefit, that's 10 grand a month. Wow. Perhaps you might say, I'm even making more money when I'm not working. What about critical? Once you have heart attack or stroke, that gives you up to 90% access to your death benefit while you're alive. And God forbid, if you become terminally ill, that means you're given 12 months or less to live. Man, that's 100%, regardless of how many months you pay. Now, whole life, of course, is better than term because it's permanent. And it also gives you cash value, 2 to 4%, which is good. However, because it's a debt, it's a level debt option. Whichever is higher is the amount that goes to your family when you pass away. So let's say you have 100 grand debt benefit, and that earned, let's say, 10 grand over the course of you paying the premium. Whichever is higher is the amount that will go to your family, not both. So that means the 100 grand will be the one that your family will get bye-bye to the 10,000 cash value. Okay. Now, universal is a little bit better because you can even overfund it. It's called flexible premium. And now you can choose the increasing debt benefit option, which means whatever you earn inside in the form of cash value is added to your debt benefit. So your debt benefit now is increasing as you earn more cash value. And by the way, in this platform, you could even earn more cash value because it pays more, a little bit more, like probably 2 to 6%. So it's a lot better, but it doesn't have long-term care because they only introduced the long-term care as a rider in 2014, particularly in California. Now, variable universal life, or VUL, is not even worth discussing because the fact that it's variable, that means your cash value is exposed in the market, which you could lose. For me, it defeats the purpose of a life insurance protection. So you're not actually protecting your family entirely. Now, index universal life is, I think, the best thing that ever happened to an insurance. Now, it's not for everyone. Maybe you can't afford an IUL. Maybe you're not insurable. But if you can, for me, it's a privilege to have this. Now, I call it the LIRP because it's a type of life insurance that protects you from all types of risks, like market risk, tax risk, health risk, and now you're protecting your family. Not only when you're dead, but even when you're alive. Now, by virtue of this tax code, IRC 7702, whatever you build inside the policy is tax exempt. Now, let's talk about the risk protection that it gives you. Okay, number one, it has a cash value that gives you a floor of 0.75 and a cap of 15. Let me illustrate that. Imagine this is your S&P 500 where your 401k is invested. So it goes up and down. So in 2008, the market crashed almost negative 40. So that means you could lose up to half or more percentage of your funds in your 401k or other variable forms that are invested in S&P. So that means it doesn't give you protection or safety from the market. So this type of insurance, the LIRP, is an index. Okay, that means it's not directly invested in the market, but it mirrors the market, particularly the growth up to 15%. But when the market crashes because of its safety net of 0.75, which is the minimum guaranteed interest that it earns, then it gives you the floor of 0.75. So the tendency is always going up, never going down. Imagine playing in the casino, knowing that you're not going to lose. Will you play? Of course, knowing that you're not going to ever lose your money. And it's not subject to 59.5 rule. So that means you don't have to wait till you're 60 before you can touch it. Okay. And then now you have what you call the long-term care, which means similar to that chronic illness rider. That means if you lose 2 of your 6 ADLs and it lasts for 90 days, now you're able to access your death benefit 2% monthly, which will pay for your care when you get old. Even when you're young, it provides your income replacement. And living benefits is added if you have heart attack or stroke, up to 90% of death benefit. And again, if you become terminally ill, provides everything, 100% death benefit while you're alive. So the least of your loved ones' worry when that happens is money. Now, the death benefit here is permanent. That means it's not expiring as long as you're paying it correctly. And then the cash value here is added to the death benefit, unlike the whole life, because it's an increasing death benefit option. And recently, They added a concierge service to the plan, meaning they even make the funeral arrangements if your death benefit is 250K and up. That is amazing. So let me illustrate how good this is. Now, you're practically covering all the bases, all the four cornerstones of a wise plan, because now you're beating inflation because you're averaging 8.2. And you also have a safety net. Instead of roller coaster, you are more like an escalator because you're not participating in the downside market. And because of IRC 7702, you're protected from future tax liabilities. And you don't even have to get sick to access your cash value up to 90%. And of course, when you become critically or terminally ill, there's that access. And when you need care, like nursing home, or you need a caregiver to take care of you, the long-term care kicks in. And when you pass, you're sure that your family will be taken care of. Practically beating all the wealth killers here: inflation, market risk, taxes, and now have a roadmap. Now, is this for everyone? Absolutely not. If you have a 401k and your company is giving you matching, by all means, take advantage. But you don't have to put everything there. This kind of plan gives you a balance where you can diversify some of your savings so that you can build what you call tax advantage account while protecting yourself and your family as well. So how may I help you? Tell us what you need. Maybe you just want to understand how to protect your family the right way, or you just want to learn how to build a tax-free retirement plan, or learn how to manage your expenses and pay off debts. You can text me or email me. I'm here 24/7. This is Ernie Diapera, your financial consultant online. Take care of yourself and your family. Love you all.